Right now, somewhere in the world, an investor is waiting. Waiting for the market to drop a little more before buying. Waiting for the election results. Waiting for the rate decision. Waiting for the recession to officially begin or officially end. Waiting for things to feel less uncertain. They have been waiting for months, maybe years. And while they wait, the market, which does not care about their comfort, keeps moving. Warren Buffett has a specific, data-supported view on this behavior. He does not call it caution. He does not call it prudence. He calls it one of the most expensive mistakes an investor can make. Not because timing the market always fails in theory, but because it always fails in practice for a specific mathematical reason that most people who attempt it never understand. In this video, I am going to walk you through Buffett's complete case against market timing, 5 proofs drawn from 6 decades of investing, historical data, and behavioral research that together make the most comprehensive argument against waiting for the right moment that I have ever encountered. Proof 3 is the one that makes the whole case concrete. A single data point about what actually happens to investors who miss just the best 10 days in the market. Once you see this number, the impulse to wait will never feel the same. Stay with me. Let me start by being precise about what market timing actually means, because there is a version of the idea that sounds reasonable and a version that destroys wealth. The reasonable version: over time, prices matter. Paying less for the same business produces better returns. Buying at the peak of a bubble is worse than buying during a correction. No serious investor disputes this. The wealth-destroying version: waiting for the optimal moment to invest, the perfect entry price, the ideal macroeconomic setup, the right political environment before deploying capital. This is what most people mean when they say they are waiting for the right time. The gap between these two versions is the whole argument. Valuation sensitivity is rational. Waiting for certainty is not, because certainty never arrives. Buffett has said he has no idea where the market will be in 6 months. He has said he would not change a single investment decision if someone told him, in advance, what the economy would do in the next 12 months. He has described macroeconomic forecasting, including his own, as essentially worthless for investment decision-making. His position is not that macroeconomic conditions do not matter. It is that nobody can consistently predict them, and therefore attempting to time entry and exit around those predictions produces costs. Miscompounding, transaction costs, tax inefficiency, that almost always exceed any benefit. He backs this position with something more persuasive than opinion. He backs it with data. Nobody has ever done it consistently, not even the best. The evidence. Market timing, to be profitable, requires being right twice. Once when you exit the market anticipating a decline, and once when you re-enter anticipating a recovery. Getting one of these right occasionally is possible. Getting both right consistently across multiple market cycles has never been demonstrated by any major investor with a verifiable long-term track record. The investors with the best long-term records, Buffett, Munger, Peter Lynch, Howard Marks, Ray Dalio, share one characteristic. They are not market timers. None of them built their records by correctly predicting when to be in and when to be out. They built them by owning excellent businesses or diversified portfolios for extended periods, through market cycles rather than by anticipating them. Lynch, who ran Fidelity's Magellan Fund and generated the best mutual fund record of his era, was explicit about this. He said that far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has ever been lost in the corrections themselves. Why this matters? If no major investor with a verified long-term track record has built that record through market timing, including the investors who are the most sophisticated, best resourced, and have the most information available to them, the reasonable conclusion is that consistent market timing is not possible. This is not a claim that nobody has ever made a lucky timing call. Many investors have, but luck is not a repeatable strategy. The question is whether consistent, systematic market timing has ever been demonstrated to outperform consistent, long-term ownership. The evidence says no. What you do instead: stop looking for proof that your timing instincts are correct. Start asking instead, what is my evidence that I can do something consistently that no verified long-term investor has ever done? If you cannot answer that question with specific, verifiable reasons, not confidence, not a gut feeling, not recent performance, then market timing is not a strategy. It is wishful thinking dressed as analysis. Proof 2 is about what happens when you exit the market and the timing is even slightly wrong. The mathematical cost that most investors dramatically underestimate. The cost of being wrong once, compounding works against you. The mathematical reality. Most investors who attempt market timing think about the upside, the crash they will avoid, the bottom they will buy. They rarely think carefully about the full cost of being wrong. Here is what the cost actually looks like. Suppose an investor exits the market in January because they are concerned about a potential correction. They are right, the market falls 15% over the next 6 months. They feel vindicated. Now they wait for the bottom. But the bottom is only obvious in hindsight. In real time, every temporary recovery looks like a potential bottom, and every continued decline feels like confirmation that more losses are coming. Research consistently shows that most investors who exit during a decline re-enter only after a significant portion of the recovery has already occurred, if they re-enter at all. The investor who avoided a 15% decline but missed the subsequent 30% recovery is worse off than the investor who simply held through both. The compounding dimension. The second cost of market timing is the compounding foregone during the period out of the market. A portfolio of $100,000 growing at 10% annually doubles approximately every 7 years. Every year spent out of the market waiting for the right moment is a year of that compounding lost. Not reduced, lost permanently. The base from which all future compounding grows is smaller than it would have been. Over 20 or 30 years, the difference between being fully invested throughout and spending even 2 or 3 years on the sidelines is not marginal. It is substantial, often the difference between a comfortable retirement and a genuinely wealthy one. Buffett understands this intuitively. He has said that his number one financial rule is never interrupt compounding unnecessarily. Exiting the market to wait for a better entry point is, by definition, interrupting compounding unnecessarily, unless you can be certain you will re-enter before the compounding you missed exceeds the decline you avoided. What you do instead, before exiting the market for any macroeconomic reason, calculate what you need to be right about for the timing to be net beneficial. You need to be right about the decline coming, right about its magnitude, and right about your re-entry timing. The probability of all three being correct consistently is vanishingly small. Most of the time, the mathematically expected cost of attempting the timing exceeds the expected benefit. Proof 3, the number I mentioned at the start. The data point that makes the entire case for market timing collapse. Miss the 10 best days, lose most of your returns forever. The data, the peak proof. This is the single most powerful data point in the entire case against market timing. Comes not from Buffett's opinion but from decades of market return data. Over the past 30 years, if you had been fully invested in the S&P 500 throughout, your annual return would have been approximately 10.7% per year. If you had missed only the 10 best single days of market performance over those 30 years, 10 days out of approximately 7,500 trading days, your annual return would have fallen to approximately 5.5%. Missed the best 20 days. Approximately 2.1% per year. Missed the best 30 days. Negative returns. 10 days out of 7,500. The difference between genuine wealth creation and effectively losing money over a 30-year period. The critical detail when the best days occur. Here is what makes this data so devastating for market timers specifically. The best days in the market, the biggest single-day gains, almost never occur during periods of calm, confidence, and obvious opportunity. They occur predominantly during periods of extreme volatility, specifically during and immediately after the worst periods of market decline. 8 of the 10 best single days in S&P 500 history occurred during bear markets. Many occurred within days or weeks of the absolute market bottom. Precisely the moment when fear was at its highest, when the news was worst, and when every instinct of a market timer was screaming to stay out. A market timer who exits during the decline to protect themselves from further losses is almost certain to miss the violent recoveries that account for a disproportionate share of total long-term returns. They avoid the worst days and miss the best ones. The two sets of days are clustered in the same periods. Buffett's response to this data. Buffett does not cite this specific study, but his behavior across 60 years is its practical application. He was a net buyer of equities during the 2008 financial crisis, committing $5 billion to Goldman Sachs in September 2008, one of the most fearful moments in modern financial history. He was buying during the pandemic crash of March 2020. In each case, he was not predicting the bottom. He was buying great businesses at reduced prices, accepting that the timing would not be perfect, and trusting that the compounding over the following decades would make the precise entry point irrelevant. He was in the market for every best day, because he never left. What you do instead, commit to a simple rule. I will not exit the market for macroeconomic reasons. I will exit specific positions if the investment thesis changes, if the business deteriorates or the valuation becomes genuinely extreme. But I will not go to cash because I am worried about the macro environment, because the macro environment is precisely when the best market days are most likely to occur, and missing them is catastrophically expensive. Proof 4 is about the experts. What happens when professional economists and market strategists attempt market timing with their full resources and research budgets? Experts fail at it too, the professional forecasting record. The evidence. Every year, major investment banks, Wall Street strategists, and economic forecasting firms publish their predictions for where the market will be at the end of the year. These predictions come with significant resources behind them: large research teams, proprietary models, access to company management, and decades of institutional experience. The collective track record of these predictions is, to put it generously, poor. Studies that have tracked Wall Street year-end S&P 500 forecasts versus actual outcomes consistently find that the consensus is wrong more often than random chance would predict, and specifically, that the consensus systematically underestimates markets in bull phases and overestimates them in bear phases. In other words, professional forecasters herd toward the recent trend rather than correctly anticipating reversals. The 2008 financial crisis was not forecast by the consensus of Wall Street analysts in January 2008. The rapid recovery from the COVID crash in 2020 was not forecast by the consensus in April 2020, when most predictions were for extended economic damage. The extraordinary bull market of 2023 was not forecast by the consensus in January 2023, when most strategists were predicting a recession. Buffett's view on expert forecasting. Buffett has been explicit about his assessment of professional market forecasters. He has said that forecasters make predictions not because they know the answer but because they are asked, and that there is a significant industry incentive to make specific predictions rather than to honestly say, "I do not know." He has joked that the purpose of market forecasting is to make astrology look respectable. The joke contains a serious point. Astrology and market forecasting share a structural similarity. They make specific predictions about inherently uncertain future events, and their proponents can always explain, after the fact, why the prediction was almost right. His advice: do not make investment decisions based on any macroeconomic or market-level forecast, your own or anyone else's. Invest in individual businesses you understand, at prices that offer a margin of safety, and let the long-term compounding of those businesses generate your returns regardless of what the macro environment does. What you do instead, when you find yourself reading a market forecast from a bank, an analyst, a financial media personality, ask, what is this person's verifiable track record? Not their most recent correct call, but their full record across multiple market cycles. If that record is not available or is not consistently better than random chance, the forecast has zero informational value for your investment decisions. Treat it accordingly. Proof 5 is Buffett's own alternative to market timing, and it is simpler than almost anything a sophisticated investor expects. Time in the market beats timing the market, always. The positive case. Everything we have covered so far has been about why market timing fails. Here is what Buffett advocates instead. His core message to ordinary investors, stated in multiple shareholder letters, annual meetings, and interviews, is consistent and simple. Invest regularly in businesses or index funds that represent excellent long-term value, and do not interrupt the process based on short-term macroeconomic concerns. He made this recommendation in his most famous investor bet. In 2007, he wagered $1 million that a simple S&P 500 index fund, held for 10 years with no market timing, would outperform a portfolio of hedge funds actively managed by sophisticated professionals. The result, measured at the end of 2017, the index fund returned approximately 125% over the decade. The hedge fund portfolio returned approximately 36%. The professionals, with all their resources, research, and active management, including whatever market timing they attempted, dramatically underperformed a strategy of simply staying invested in the market throughout. The specific Buffett approach to deployment. Buffett does make valuation-sensitive decisions. He prefers to buy when valuations are lower and is more selective when markets are expensive. But his valuation sensitivity operates at the individual business level, not at the market level. He does not go to cash because he thinks the market is overvalued. He simply becomes more selective about which businesses meet his return threshold at current prices. For ordinary investors who do not have the time or inclination to evaluate individual businesses, his recommendation is direct. Use dollar-cost averaging. Invest a fixed amount at regular intervals regardless of market conditions. This approach automatically results in buying more shares when prices are low and fewer when prices are high. It does not require any forecast. It does not require any prediction. It simply requires the discipline to invest consistently regardless of what the market is doing. The final data point. Research on dollar-cost averaging consistently shows that it outperforms lump-sum investment time to market conditions in the majority of scenarios. Not because it is the theoretically optimal entry strategy, but because it removes the psychological barriers that prevent most investors from deploying capital when conditions feel uncertain. The best time to invest, Buffett has said, is when you have money and the business is worth owning at its current price. Not when the economy looks certain. Not when the political environment is calm. Not when the market has given you the signal you were waiting for. Because that signal is never coming. And the waiting has a cost that most investors never calculate until it is too late. 5 proofs. 1 conclusion. The waiting is not protecting you. It is costing you. Let's bring it together. Proof 1. Nobody has ever done it consistently. Not Buffett. Not Lynch. Not Marx. Not Dalio. The investors with the best long-term records built them by staying invested through market cycles, not by predicting them. Proof 2. The cost of being wrong once is severe. Missing the re-entry, interrupting compounding, and forgoing the years of growth that follow every recovery. These costs almost always exceed the decline that was avoided. Proof 3. Miss the 10 best days and lose most of your returns. Those 10 days occur during the most fearful, most volatile periods, precisely when a market timer is most likely to be out. The best days and the worst days cluster together. You cannot avoid one without risking the other. Proof 4. Experts fail at it too. Wall Street strategists with full research budgets and decades of experience are wrong more often than not on market-level forecasts. There is no reason to believe any individual investor can do better with fewer resources and less information. Proof 5. Time in the market beats timing the market. Regular investment, maintained through market volatility, is the single strategy with the clearest long-term data supporting it. The Buffett bet proved it over a decade against the most sophisticated active managers in the world. Here is the honest summary. There is no perfect time to invest. There has never been a moment when the economic environment was so obviously stable and the political situation so clearly benign and the market so unambiguously undervalued that every investor agreed it was the right time. 1965 had the Vietnam War. 1975 had stagflation. 1987 had Black Monday. 2001 had September 11th. 2008 had the financial crisis. 2020 had the pandemic. 2026 has its own set of reasons to wait. The investors who waited for certainty in each of those years are still waiting. The investors who stayed invested through all of them are, in most cases, wealthy. The waiting has a cost. Compounds quietly, invisibly, year after year. And unlike the volatility you are waiting to avoid, the cost of not being invested never reverses. This closes week 7. Next week, we continue building the most comprehensive billionaire investor education series on this channel. The next video is right here.